Thank you very much. Good afternoon, everybody, and welcome back to the 2021 Malaysian Housing and Property Summit. We had a very good informative session this morning, and we hope to continue that momentum into the afternoon with even more interesting topics. So today's this topic we're going to cover today is strategic outlook and trends in the property sector. We've broken up this this moderation panel discussion into three sectors with Surveyor Michael Kang will do a market overview heading into the new normal. Pravin will do a condominium and residential sector, and Fu will come and do the commercial and industrial sector. Following that, we will do some, as quickly as we can, try and answer as many calls as we can. So the three gentlemen in front of you are no strangers to the world of property. They are like a who's who. And I think the MC has already introduced them a little bit. But let me just add on to say that Fuji Jen is the managing director of CBRE WTW, and I think he's had more than 30 over years in the real estate industry. He was previously the president of PEPS, as well as have sat in the board in valuers, appraisers, estate agents, and property managers. Previn, of course, is the founder and CEO of Zerin Properties, a Malaysian-based real estate agency with offices in Singapore, London, and India. He's been involved in many corporate real estate deals, especially hotel transactions, and he was also instrumental in setting up the Cornet Global, which is a Malaysian networking group for corporate real estate players. Michael Kong is currently the president of the Malaysian Association of Valuers and Property Managers, property consultants in the private sector, acronymed as PEPS. And he is a specialist in asset appraisal, which is real estate, plant and machinery, marine vessels, and business valuation. Career spanning over 26 years. He specializes in litigation support valuations. So without much ado, let's very quickly bring the three panelists on, and we will start with Surveyor Michael. Over to you, Michael.
All right, thank you very much, Siva, for the kind introduction. Good afternoon, everyone. First of all, let me thank KSI as well as PEPS for inviting me to have to be in this talk. Okay, now I've been given the relatively easier task, okay, on the general outlook of the market, okay, and where is the property market heading in the new normal. So to address that, perhaps let's have a background and look at how the property market performed pre and during COVID. Can I have the first slide, please? The next one. Okay. Now, as you can see from the chart, the property market responded rather logically to the outbreak of COVID-19 and its subsequent movement control orders. The nation went into a full-blown lockdown on 18th of March 2020. That's the first quarter of 2020. The market at that point in time was healthy at 72,867 sales with 28.58 billion worth of transaction. Now, MCO 1.0 lasted from 18th of March to the 3rd of May 2020. So the whole of Q2 2020 was muted. It recorded a drop of 41.5% to 42,609 sales at 18.35 billion. As the number of COVID cases started to drop, the government relaxed the measures and the nation went under CMCO and RMCO from May to December 2020. Evidently, the market recovered some lost grounds with healthy transaction volumes and values. However, the pandemic started to worsen again, and the country had to undergo another strict lockdown on 13th of January 2021. And then furthermore, MCO 3.0 was imposed on the 3rd of May 2021. And finally, FMCO, the full MCO, on the 1st of June 2021. Consequentially, the first quarter results were impacted. Okay, but interesting to note that the first quarter of 2021, the results was slightly better than the first quarter in 2020. This could be possibly due to the spillover effects from the last quarter of last year, Q4 2020. So perhaps we need to look at the performance of Q2 2021 to judge further. The Q2 figures are not out yet, but I do expect the Q2 figures to be bad though, because of the strict lockdowns that was imposed. Now, we have seen the performance of the market pre and during COVID. To understand or predict how the market, not to say predict, maybe have a calculated guess how the market is going to move forward, we need to maybe look at a historical real estate cycle. Can I have the next slide, please? The next one. Okay, thank you. Okay, I'm by nature a fairly optimistic person. You know, what goes down must come up. But the question is when, okay? So we need to have a look at the historical real estate cycle, look at the chart from 1991 to year 2020. And I believe after every major crisis, the market will rebound and recover rapidly to make up for lost times. If you look at the previous chart, I mean the last 20 over years, we can see this in the last two financial crises. The Asian financial crisis struck us in 1997, and the market dipped tremendously in 1998, but recovered almost immediately in 1999. Same goes for the subprime mortgage crisis in 2008, which plunged the market in 2009, and subsequently rebounded ferociously to a new peak in the value of transaction in 2014. Okay. Now I expect the pandemic to be under control by end of the year, because now the vaccination program is full force. You know, I expect full vaccination to be completed by end of the year, and we should see a robust recovery starting 2022, which is next year. And the current climate is also quite conducive for property investment. The low interest rate regime would attract higher investment, consumption, and growth in the market. And Budget 2021's 15 billion allocation to revive and to ensure the continuity of mega projects will also provide a much needed boost to the real estate industry. I think earlier in the earlier session, some of the speakers have also mentioned the big mega projects such as MRT Line 3, the double tracking, and Pan Borneo Highway. These are all the mega projects, infrastructure projects that will help to boost up the real estate industry. Of course, there's also the HOC, the Homeownership Campaign, which is running until end of the year. This will be the added impetus to house buyers to purchase in the down market now, okay, and wait for the recovery starting next year. Okay, that is basically more or less what I can share, my opinion of how the market is going to respond come 2022. Now, I've also been asked to maybe touch on a little bit, very briefly, on MM2H program in relation to the property market. Can I have the next slide? Okay, thank you. Now, the MM2H program was temporarily suspended in the middle of last year, pending review and re-evaluation. The Tourism, Arts and Culture Ministry, MOTAC, has announced the review of the program has been completed and ready to be presented to the Cabinet for approval. But as of now, we still have not heard any news. There's no new news on this matter yet, so we are still quite hopeful that it will be announced soon. Okay, the MM2H program was started in 2002. Since 2002, the government has approved around 48,000 foreigners to reside in Malaysia under this program. There's on average around 2,600 foreigners over the last 18 years. Okay, can I have the next slide, please? Okay, now this slide shows that, the criteria for the approvals, okay? But I would not go into details on this, but suffice to say that we need the MM2H program to be reactivated to draw foreign funds and talents to help boost our economy. And I sincerely hope that the government will relook into these policies to be more forward-looking, more investor-friendly, and hassle-free. We need this kind of long-term strategies and policies to attract foreigners to invest, okay, and basically, invest in real estate or FDIs, and also the accompanying skilled foreign talents. And very importantly, we have to create a safe, friendly, welcoming environment to entice these skilled foreigners to stay, to work, and to play. We really have to simplify the rules and the guidelines and be very consistent, okay? Very consistent in the strategies and the policies. Okay, and I'm sure everyone would agree that all these sound government policies with regards to real estate would serve as a booster or a catalyst for the property market. We really need to restore confidence back to the market. That's all I have. It's quite brief. We'll try to take more on the Q&A. Over back to you, Siva. Thank you very much.
Thank you very much. Thank you very much, Mike. I think that was a very good overview on what's happening, and I think the takeaway from this would have been the fact that our property market has been a little bit in the doldrums, a little bit slow, fluctuating for the last few years. What we needed was a bit of an impetus to push it forward, but unfortunately, COVID has come and mess things up a little bit. So hopefully when we get into the question and answers, we will try and address what the issue is and what we can do maybe moving forward into 2022, 2023 and thereon. Our next panelist, I will hand it over now to Pravin to do the residential sector. Over to you.
Thanks, Siva. Thank you very much. Good afternoon, everybody, and happy Tuesday. Thanks again, Siva, for having us, and as always, greetings to my respectful fellow panelists. I will cover the market focusing in Klang Valley and Iskandar, Malaysia. Firstly, the Klang Valley market. Sorry, could I have the slides, please? The next one, yeah. The elephant in the room has and will always be the overhang. As you can observe, the overhang in Klang Valley grew by 8.48% in terms of number of units and 12.88% in terms of value. This is, of course, due to a lot of previous property overhang. And I do see it to increase as the properties launched in 2019, which were already part of the problem, come into the picture. The problem then was just enthusiastic building. I think everybody never held back and just went forward and launching without proper market study analysis about what the buyers want and what the buyers can afford. All this, of course, was already in the change, but I think the change was accelerated in early 2021. Now, we also have the breakdown of the overhang. As you can see, majority of it is residential properties as opposed to serviced apartment, and it's all in the range of 500,000 to the 1 million ringgit range. So for me, this overhang is actually part of a past legacy. It was around during the pre-COVID days already and will be around unless corrective action is taken by the developers themselves, which brings us to the present. Surprisingly, the residential demand in Klang Valley remained very steady, even though in the COVID-19 pandemic. Mortgage approval trends continue to rise, and developers got very creative at driving sales. This was mainly driven by strong digitalization. I'm sure many of you all have already seen it. They have digital galleries and launching through social media, etc. readjusting of prices to suit the affordability of the buyers, and new launches that again adapted to what the buyers wanted. This, of course, is being helped by the advantageous move by Bank Negara to maintain the record low overnight policy rate and the ongoing Homeownership Campaign. To give you an idea, in terms of value of transaction, there was a fantastic growth of 28% in 2021 as compared to, in the first quarter of 2021 as compared to the first quarter of 2020. And in terms of volume, there was an increase of about 19.5% in quarter 2021 as compared to quarter 1 2020. We truly have a resilient market. I think the important point to note is that in quarter 2021, it was actually just before MCO. So the problem was already pending, as what Siva said just now, right? We already were heading towards the slowdown. Whilst the number you see in quarter 4 2020 and quarter 1 2021 are after the MCO, truly reflecting a strong, resilient, and I think a lot of pent-up demand of buyers. What we are observing on the ground is three-pronged. Firstly, the high net worth individuals and the ultra high net worth individuals are still very active in the market. They are paying top dollar for properties that otherwise would not be in the market, and are also looking at opportunistic buys in the high-end locations. They are very active. The second prong is the below 500K range. This is for our burgeoning middle-class market. This seems to be the main artery and the pump of the residential market. And thirdly is what I call the pricing overhaul. I think we all have seen what the developers are doing. There's been a massive, as I said, overhaul of the overhang, where developers are letting go of their inventory, and we've seen discounts up to 45% from the inventory at this present juncture. And again, from this slide, you can see that another trend we are seeing, new plan supply is all skewing towards landed properties. Could I have the next slide, please? Next, we cover the market in the Iskandar region. This is probably the most and the worst hit market in Malaysia. The overhang is close to double of Klang Valley. Last year, the overhang in Iskandar grew 3 times more as compared to Klang Valley by 27.94% in terms of number of units. Again, like Klang Valley, I do see the increase next year as well, as properties launched in 2019, which were already part of the problem, come into the picture. The problem was the same, zealous building and launching without proper analysis. We also have the breakdown of the overhang. Here, it's totally the opposite. 73% of the overhang is in the service apartment sector, as opposed to residential, and also in the 500K to the 1 million ringgit range. However, I think the very astute Johor developers saw this coming and switched to landed properties very quickly. And you can actually see it from the incoming supply, the planned supply, and the new set planned supply, which is 100% landed properties. This has also resulted in very good sales, as you can observe the sales number in Q1 2020 as compared to Q4 2020. However, when we compare Q1 2020 to Q1 2021, in terms of the number of units, there was a drop of 10%, which is not bad considering, but in terms of value, it increased by about 4%, which from our research shows a lot of residential properties, landed properties actually, and well-located condos, which were picked up mainly by locals. What we did early this year is we actually immersed ourselves for 14 days in Iskandar, me and my research team. And what we found out that there is actually a very strong local ecosystem. The companies that were aware of this immediately took the opportunity and leveraged on that, while others who lamented and moaned that JB depended on Singaporean buyers really suffered. This is a big difference than depending on Singapore, right? Depending on Singapore and depending on Singaporean buyers are two different things. There is a symbiotic relationship between JB and Singapore, but I think the opportunity is actually very domestic. Another trend we are observing throughout Malaysia actually is that developers are now securing their future already. They're securing with strategic land banking. I think you all would have all read about Legenda making big moves into the market in the affordable housing, securing 500 acres in Kuantan, and UEM Sunrise recently with 2 Stella investments, and Sunway Properties as well with 2 investments into Cheras, and the rest being Tadmax and Binastra, who have all made examples of very high profile land banking deals. Before I end, I would just like to say something. what I found amazing in the recent months is that mortgage applications and approval values remain close to historical peaks, right? It's close to, I know we were from a low base last year, but the rebound was close to 200% year on year. And I think this will continue to be driven by strong pent-up demand, our resilient market, low interest rates, and the ongoing home ownership campaign, which I think will bode very well for the market. Siva, back to you.
Thank you, Pravin, for that outlook on the residential market. And yes, you're right, it is the elephant in the room. The residential market in any given year accounts for between 63, 64, 65% of all real estate transactions. So with so much of emphasis being placed on one sector of the market, any disturbance in that sector actually triggers a bit of a property tsunami across other sectors as well. And unfortunately, everything's connected to the hip like Siamese twins, and residential has now in the last few years suffered a fair bit of damage through the overhang and unsold units. It's something that I think the market has rushed in the last couple of years to address with slowdown of launches, less units and everything. So with some hope, we will try and see how that can be mopped up in the next couple of years. Last but not least on the panelist is Surveyor Fu Jijen, and he will cover commercial and the industrial market. Over to you, Fu.
Thank you, Siva. Very good afternoon to all. First of all, I would like to take this opportunity to thank you, KSI and also FIAPSI, for inviting me to share my view on the strategic outlook and also the trend of the commercial property. I will try my very best to cover the sector for the office and also retail market, and also will touch on a bit on the industrial subsector. As the previous speaker mentioned, I think the focus is generally my coverage would not be so much of the elephant in the room. There's so much of the bad news talking about oversupply of the office building and also the retail space, the pressure on rental occupancy rate of all-time low at the moment. Let's be a bit more positive. I think as what the in the opening speech of our Tan Sri and also Tu Tan Sri, I think let's look in the positive side. What in store for us post-pandemic and how we prepare ourselves moving forward, especially and looking at as what Tan Sri Lee Kim Yew mentioned, opportunity that lie in front of us moving forward. Now, I think during the COVID, this is something has been unprecedented. I think some of the analysts have mentioned this is worse, the mother of all the crises in terms of the property, worse than the Asia financial crisis, worse than the dot-com and of all. These are the period that no cross-border. I think in terms of Malaysia, no cross-state and no cross-district. I think we have been tying, our hand are tied, our leg are tied. So almost everything is tied down and we have to do everything virtually. So this has prompted the company to be under comprehensive review in terms of their real estate portfolio and the future of how the office space requirement going to be looking forward in the near future. Can I have my first slide, please? So what I'm going to share with you generally will be how the shift of the working pattern and the moving forward, how the company and the occupier or landlord going to prepare in terms of when the lockdown is open and how are we going to prepare ourselves. At the present structure, pre-pandemic, the office system and the structure is very much rigid. You have a HQ, then you have satellite offices, Some of the office have been working on the project side, and flexi space have been adopted. But moving forward, I think the office will be relying a lot more on technology. I think these are the key things. Technology are the key thing, the prop tech and others. So, but I would like to say that are we looking at this going to be on permanent basis, or this going to be a short-term measure that we take? Generally, I think the answer is yes and no. I would think moving forward, we're going to be looking at very much hybrid working in the new norm, depending on very much your business strategy, your workforce strategy, your workplace solution. So these are very important things for every occupier and landlord need to look at. So post-pandemic, how is this structure going to be? It's going to be a lot more complex. It's just like a spider web. The issue of things like working from home, first of all, everybody will be concerned about business continuity plan, right? So how are you going to make sure business as usual, where everybody is working remotely? So the concern here will be work from home will be something that will be a permanent feature, but concern will be whether this is going to be the dominant factor within the office structure. My take would be generally may not be, but certainly I think these are the things that you require. Now, so the HQ in the CBD area may not be something of really top on the list in terms of prominent, right? You don't really have to have a large support within the HQ where all the technology are focused on that. I think the cloud will be something that you are looking at. Does that mean that the office space in the CBD will be shrinking in terms of the size? My answer to that will be yes and no, because at one end, you have less people working in the HQ. People will be looking at more either working from home. It can be a split team, alternative team, 1 week in the office, 1 week off at home. And there's so many hybrid solution that it can be done. Then the office, how the office is going to be look like? Wellness will be a key thing moving forward. Apart from technology, people are concerned whether you are really the office is safe for you to go back. Now, in terms of flexibility, meeting place, and all this, completely, whether are we going to go back in due to the wellness concern and safety in terms of health? Are we going to reversion back to conventional cubicle rather than open plan? So these are something that really the occupier and the landlord need to look into that. To me, in the short term, certainly there will be a reduce in terms of demand because everybody would reduce their space requirement. So redesign of workplace certainly would be something in the mid-term or short term. But in the long term, I believe certainly there will be a merging of premium requirement for the office, meaning the office, you need to have a ratio of 1 person to a space, which in Malaysia context, generally we would be happy to have about 60 to about 80 square feet per pad in the office. But moving forward, you reduce your workforce because 30% of your workforce will be working from home or working virtually in the Starbucks. On the other hand, due to the safety and health concern, perhaps you need to be a bigger space in the office. So to me, in the long term, there is still a need to go back to the office, and the demand would probably go back to the norm in probably 3 to 5 years. Now, on the occupier side, in the light of the economic downturn now with the pandemic, the occupier will also hard pressed to spend a lot on the CapEx. So certainly, I don't think this would be the right time for you even to consider to really redesign your office. I think the main concern of all the occupier will be to make sure the business are back to the usual, focus more on your business and how you need to move forward. My second slide, please. Now, this just to illustrate will be how the moving forward, the office going to be and before. The workstation design. At the moment, I think we are looking at very much hot desking. It's like a classroom, everybody just log in and book the place and so forth. But moving forward, perhaps I think everybody are a bit concerned who are the one occupying the place before you. Sanitation and auditing would cost a lot of money. In terms of private space design, current space and the future, that will be a lot more concern about, are we back to the cubicle space? In terms of collaboration, these are something that collaboration space will be very much different. Meeting room will be very much a lot more casual. Perhaps we are bringing home to the office, right? There will be a time that you look at the setup in the future meeting room, you are bringing home to the office rather than office to home. So it's a hybrid thing that's going to happen moving forward. Okay, so generally, as I say, my take on this, in the short term, the demand will be very badly affected in terms of office. But I'm very optimistic, I think, for the year 2022 toward the tail end 23, I believe we will see a lot more new demand and definitely a different kind of office environment that will be experienced for the near future. Okay, next slide, please. Okay, suffice to say about the office segment. Just to touch on office segment, I think for the benefit of all the audience, at the moment, the office, there's not much of termination happened during this, even during the pandemic. We have been gone through almost about 1.5 years. We are still positive. I think many people are still going to, in light of the, rather than moving and spending on CapEx, you probably will go back to your landlord and asking for some white flag, so to speak, as a tenant, ask for certain discount or waiver or rental. So moving forward, definitely, I think there's still occupancy rate may have a slight reduce. I think last year at the point of before the pandemic, the vacancy rate was hovering around 17 to 18%. As of today, despite the 1.5 year lockdown, is only increased by mere 1.5 to 2%. So we are at a vacancy rate of about perhaps about 20% vacancy rate. So to me, it's still very healthy and is still manageable. Now, on the retail sector, probably I think I will not touch on how much the sector has been affected. During the lockdown, I think the purchase are limited mostly due to the essential item. So we have experienced almost a double-digit negative growth quarter to quarter. And even for the first quarter of 2021, we still have a negative growth of almost about 4 to 5%. So moving forward, again, the key thing here is the adoption of the technology. Big data are very, very important on how we're going to make sure the retail sector are able to rebound. So the design of the shopping mall or in terms of the delivery of goods will change completely. So you will have the emerging of the online e-commerce and others. In fact, during the last 1.5 years, one of the reports for the global retail market has shown that the e-commerce have almost growth by 5 times within the 1.5 year. Compare that you have taken the growth in the country that would happen over the need 5 years for that kind of growth to happen. So definitely this is the e-commerce in the area that we need to pay attention to. So apart from the technology, I think there is also other thing that we will look at, the high tech. We are talking about smart mirror that you need to, sometimes you buy thing, really you can fit into your buying a shirt or even buying a running shoe. Sometimes you need to try on. So this can be done actually virtually. The emerging also thing that curbside pickup. So not only, I think some of the retailers are not looking only on offline or online, but combine both in terms of delivery to them. So safety and health may be something very important. Perhaps moving forward, the open concept mall, like Wangsa Mall, Cipta Mall, or even Sunway Giza, where a lot more, you feel a lot more safer, where you have an open ventilated area for you to go in rather than an enclosed area with an aircon. So these are the trend perhaps the retailer need to look at. Now, talking about retail, definitely I think I would be unfair if I not touch on the emerging of e-commerce. So I would like to briefly touch on that on the next slide. Yeah. Okay, you see the globally, I think during the 2015, the online business only attribute about 8% of the global retail market. But by 2020, it's almost more than double. Okay, so by 2021, I believe this number is going to be even bigger. I think this is very true even in my own context. I think for the last probably 10, 15 years, I only purchased things 5 times online. But during the 1.5 years, I already bought 20 items online. Okay, one of the things I bought is a shaver. I need to probably maintain. So these are the things probably is happening. And really, I think something for me, even I buy, can you imagine, I buy the some of the from the my landscape from the nursery to buy some of the from my gardening plant. I buy a steak horn. I have a new hobby during this period. I bought a steak horn online. Can you imagine? And I was amazed. And this delivered in the packaging, and everything was given to me, and I can really transplant that into my garden. It's amazing. I think how the thing have done. Talking about the e-commerce, of course, I think the thing that really emerging from the e-commerce is people are getting a bit very, I would say, very impatient when it comes to online purchase. If 10 years ago or 5 years ago, when I ordered my first iPad, that will be delivered to me within the next 2 weeks, 1 month. This is acceptable. Today, if I want to buy my hair, what is that? Hair shaver, this can be delivered to me within 2 days. I have a choice whether you want to deliver in 1 week or 2 days. So people are getting a bit impatient and they want things to deliver to them immediately. So this will come where logistics space requirements are getting very, very real. And even we are talking about last mile delivery, which I'm going to touch on in my next slide when I go on the industrial sector. Okay. Now, of course, I think during the lockdown, even industrial sector are impacted. But the good thing about Malaysia, we have some of the manufacturing sector are still going strongly, especially with the health-related PPE, growth making, or even I spoke to some of the people in the packaging business. Packaging, because when you order your Grab food, you order all from even your mama store, you see nowadays the packaging getting very innovative and people try to outdo each other. So even packaging for plastic, paper, product, and other, they are doing fantastic business and expanding during this period. Of course, we are saying that the logistic and warehousing is something that I have been promoting for the last 5 years. There is definitely a demand for this, but lately, as I mentioned, the last mile delivery is something that getting a lot more important because people are getting very impatient. They want things to be delivered to you within the next 5 hours. Okay, so there will be a merging of that. Talking about e-commerce, talking about the virtual meeting and others, I think I would also want to touch on also a merging of a large demand of data center. So this is something that perhaps the country should be looking at because I'm a bit surprised when I do a bit of research on data center. We support from our CBRE Asia Pac research. Malaysia fell behind Singapore and Indonesia and Thailand in terms of data center. So I will share with you with the next slide to see why I mentioned about that. If you look at this data center, this pandemic lead demand for cloud storage, video conferencing, online schooling, even gaming, home entertainment, social networking, virtual social networking on working from home platform have probably this demand has surged almost about close to 47% in the year 2020 compared to the conventional growth of about 8 to 9% annually. So can you imagine the search for the data center is almost 5 times during this period. And in Asia Pac, if you look at my map here, country like Indonesia, we have in 2021 and 2022, there will be 3 major data center hub will be built in Indonesia. And of course, these are dominated by the hyper-scale cloud provider like Alibaba, Amazon, Google, and Microsoft. So on Malaysia front, we have during April this year and now the collaboration with Microsoft to build a mega data center, but that would only be ready by 2023. We are still behind. And you look at Indonesia, they have 3 major, and they already commissioned the construction, and we are still lagging behind. So certainly, I think in terms of the technology, in terms of readiness, in terms of well-educated English-speaking professional in Malaysia, we are way ahead in Indonesia. But unfortunately, Indonesia are way ahead of us. Not talking about India and other part, either China, Taiwan, or others. So definitely this is something that we really need to look into at. That is an area that we should look at. Okay, that would more or less conclude with my last slide. I'll be talking about my outlook. I will touch on a bit on what my take on the foreign interest in Malaysia for the retail, office, data center, or logistic. I think we are still at the state of lockdown, no cross-border traveling, even though the data show there is about 30,000 business traveler during the lockdown. Is still, I think when it comes to real estate, I think we still have to have a feel of the ground. So these are very crucial. Still that there's still a lockdown. We would see very much still on the recovery state as far as 2022, 21 are concerned. But I'm very optimistic. Beyond that, one vaccination is rolled out. The government support is there, and provided always, I think there must be in terms of the stability in terms of political scenario in Malaysia. So we are looking forward for experimental recovery. during 2022. With that, Siva, thank you very much.
Thank you, Mr. Fu. Thank you very much for that. I think the takeaway, a couple of things that the biggest thing that struck me here is the 47% increase in the growth of data centers. It's amazing. I think that's not just the e-commerce and logistics and industrial. I think the data center is we're going to see the next phase of growth. I have a few questions of my own, but I'm going to try and address the questions by the participants first. Perhaps the first one, let's tackle something that Dato Stewart made, a comment that Dato Stewart made about the fact that he said in his opinion the local market our demand cannot be organically driven by local expansion alone, and we need to be able to attract MNCs and FDIs to come back into Malaysia, and how we should maybe benchmark ourselves against Singapore and try and strive to be better than them. Perhaps very quickly, I'll take comments from the three of you. Quick 1-2 sentence so we can move on to other topics. Praveen, we'll start with you.
Siva, I fully agree. I think there's got to be a concerted effort to actually target the foreign tenants. Now with the tax being played at a level playing field now or in the coming years, I think it's a great opportunity. We have the same infrastructure or similar infrastructure to Singapore. We've got an English-speaking population, and we've got rentals and cost of living, which is about half or a third of what Singapore can offer. I really think we need to position ourselves. We need InvestKL to be empowered a little bit more to do its job.
Good. Mr. Fu, what say you?
I would think we are ready for that, but certainly I think I agree with Dato Stewart. But the thing first, do the first thing first. I think we need to get our house in order. I think we need to get to make sure in terms of the Pemuda and all these things would be very much committed in terms of delivery. We have to make business easy. Our index to do business in Malaysia are far below the rank. So we need to improve this in terms of everything, in terms of land administration system. Buying property in Malaysia is really challenging. I think you are talking about even the EPU requirement, which is obsolete. I think these are the things that we need to overhaul to get ourselves ready and make sure when people coming in and the business can be done within the shortest time possible.
I agree with you. I don't see why we need a year to conclude a major transaction when others can do it in mere weeks. A lot of it is bureaucracy, things that we are not prepared to address. But I suppose all of us at the industry as a whole may need at some point to confront the government with very difficult questions. And what we need to ask is, like Dato Su rightfully points out, why aren't we able to benchmark ourselves against Singapore? Mike, what's your take on this?
Yeah, I absolutely agree with what Praveen and Mr. Fu has said. Besides tweaking the MM2H program, which is more on the residential side, we really need to look into our strategies and our policies on how to attract foreign direct investment back into our country. There's a lot of reports to say that we have lost a lot of them, over this period of time, and we need to really put our heads together, as an collectively to re-strategize and try to attract back all these people, all these direct investments to come in, so that our offices will be taken up, our factories will be taken up, and houses and everything. So like what Mr. Fu said, that we really need to put our house in order. Okay, thank you.
Very true. I think Dato Stewart added on a little bit to say we need to let Carlsberg and Heineken open again, which I also agree to. Now, I want to address a question here from Ji Ying Tan on the issue, something very, very pertinent, very good question on the issue of unaffordability, especially house prices, unaffordability of houses, compared to house price compared to income, and household debt compared to GDP. Let's have your thoughts, gentlemen. Again, we can start with Pravin and move on in the same direction.
You know, I already think it's being addressed, Siva. You know, you look at all the new launches, right? I think the prices are really already reflecting the affordability, and the fact that developers who are clearing their stock are really dropping the prices to meet that affordability and the loan structure. I think a point that I'd like to note that, you know, I think this would be the best time to actually go in the market, because with, I'm not trying to push, I'm just saying it because another fear that I'm getting and I'm feeling in the market is the rise of construction costs because of the lockdown, right? So, but I think the market it's already automatically reflecting the affordability, but I think we need to be very careful on construction costs in the coming months.
Yes. Okay. Let me see. Let me ask another question. I want to talk about the HOC, the Homeownership Campaign, which is now it's been extended now, and recently, I think last week there was some talk about why is secondary market not covered in the HOC, and the minister has come out and said no, we are only covering the primary market. Now, I may not be in complete agreement with the minister on this, but that's another story. My opinion, my question is this, gentlemen: with the secondary market, we're talking about residential, with the secondary market covering nearly 80% of all transactions in any given year, and the primary market fluctuating between 15, 20, 22, 23% on any given year, why have we placed so much of emphasis on the 20%, which is on an overhang, but failed or ignored the 80%, which I think will be a bigger driver of the market? Let's hear some thoughts. Pravin.
Well, I mean, look, I think the issue is on the overhang is because it impacts an industry that is actually having its own ecosystem and will collapse if it doesn't happen, right? So I think that was the focus of what the government wanted to do. But I have, as you know, have always been a proponent of the secondary market. I think it has what is, you know, always fuels the transaction, fuels the banking system, fuels the legal conveyancing system. It is what it is exactly. But I think the government is just, you know, hoping on free market and for the secondary market to work on itself, to correct it, right? And the primary market just needed assistance. But I think even now you can see, as I mentioned again, you know, the deep dive by the developers in terms of their pricing is already reflecting that. However much HOC you give, at the end of the day, it'll come to price, Siva.
That's right. I agree with you that the market is very, very price sensitive now. It's more price sensitive than anything else, which probably leads to the question at hand: income versus house prices. You know, Mr. Fu, your thoughts?
Thank you, Siva. I would look at this at different angle, perhaps looking at the income rather than the pricing. What would the country need now is in terms of acceleration and also to equip our people, to upskill the people so they are a lot more effective and more productive in terms of the how the work culture and system. Perhaps I think by doing so, certainly I think we will be able to live up to the expectation to have the high net worth, larger group of high net worth people or even medium income group. These are the way the country should be modeled after. If you look into the other country where a very simple thing, you walk into cafe in other part of developed country, it managed by 2 or 3 people. Whereas in our country, if you go to a Mamak store today, probably more workers than the customer. So do we really need that kind of environment to work? The automation in terms of system on how we work in any given industry. Be it a cafe, be it in the office, we need to be a lot more productive so we can pay what we have paid to 2% to 1%. Perhaps I think that will elevate our income level. That is to me is the longer term solution, because in terms of cost of doing business moving forward, the cost of construction going to get higher and higher. The demand for assuming like now we are talking about to provide the workers' quarters at the construction site or at the manufacturing, that would certainly would increase in terms of cost of doing business. So where do we move from here? I think we have to, the only way is to increase productivity of our people.
Thank you very much. Mike, a quick take from you. We have 3 more minutes actually, so we need to try and wrap this up.
Okay, all right, thanks. Well, I agree with Pravin that the market is correcting themselves. I mean, it's all a matter of demand and supply, and I'm sure the developers are also very savvy. They know where the market is heading, and they're trying to also price their product differently. But I think the focus going forward, I think, would be on affordable housing, as what Dato Zuraida has mentioned, because the entire housing market, I think, is pivoting towards the affordability side. There's 500 million allocation to build 14,000 units under PPR, 315 million to build 3,000 under Rumah Mesra Rakyat, 310,000 for program Perumahan Penjawat Awam Malaysia. So all these are showing that the market is really going towards the housing affordability or affordable housing side. So on that part, I think the developers, they do know what to do lah. Okay, coming back to the other question about what's that on the what's the other question?
Whether the secondary market should be included in the HOC.
Correct. Personally, I feel that the benefits extended under HOC should also be, given to secondary market as well. So in order to move the market, if the sellers in the second market is able to sell, then they would move up, to the next level, so it will be a very robust market. I think personally, I think that should be extended to the secondary market as well. Thanks.
Gentlemen, thank you. We got 2 more minutes. I just want to end this with a bit of a bang for all 3 of you. 2022, 2023. What's your outlook on 22-23? Down, flat, up? Straightforward answers. Pravin.
Transactions up, price flat.
Mr. Fu.
I would take, I concur with Pravin. I think the price going to be very much flattish, yes. But probably I think the cost of doing business, the price may be a bit of correction. It's not so much of demand driven, but rather than cost push. In terms of transaction, I believe definitely, I think with the opening up of the market, everybody is eager to do more holiday, to spend money. What we have not spending for the last 1.5 years, we will buy a lot more things, retail, we go more holiday. I think the market definitely will be booming.
True. Mike?
Yeah, as what I've presented earlier, I'm rather optimistic for the year moving forward. I believe that the market will recover, would, like what Mr. Fu said, pent-up demand, it will push the market further. That's my take.
Thank you, gentlemen. I agree with y'all on this. I also think the perception, the feel-good factor about the vaccines, and the positive outlook will push the market forward. I think 2022 will be a little bit of a flattish year, and I think we'll start to see some serious growth in 2023. With that, Mr. Fu, Mike, Pravin, I thank you very much. It was a wonderful session. I had fun moderating. Thank you very much to KSI and PEPS, and we'll see you at the next event. So over to you, Mr. MC.
Thank you so much.